April 2025 marks a turning point in global economics. During his highly anticipated Liberation Day speech, President Donald Trump laid out a bold, sweeping shift in American trade policy that would shake markets from Beijing to Brussels. With a confident tone and a nationalist backdrop, Trump declared the United States would impose a universal 10% tariff on all imported goods. The most striking component? A cumulative 54% tariff on Chinese imports alone. It was a move many expected, but few anticipated happening this fast and with this intensity. Within hours of the announcement, world markets reacted. Stocks dipped, currencies shifted, oil spiked. More importantly, foreign governments prepared their response. In Beijing, the Chinese government held an emergency press conference. Their message was just as clear. In retaliation, China would impose a 34% tariff on all U.S. imports, effective immediately. But this wasn't just about trade. China's Ministry of Commerce also announced tighter restrictions on the export of rare earth minerals resources that power everything from American smartphones to fighter jets. It was a shot across the bow. Let's take a step back to understand why this is such a massive shift. Tariffs aren't new. For centuries, nations have used them as a form of protection shielding domestic industries from cheaper foreign goods. However, since World War II, the global economy has largely trended toward free trade, a world where goods move with fewer restrictions and open competition prevails. Trump's approach marks a hard pivot from that philosophy. In his view, other countries, especially China, have taken advantage of America's open markets, stolen intellectual property, manipulated currencies, and flooded U.S. shelves with cheap government-subsidized products. His message to American voters is simple. Tariffs protect U.S. jobs, rebuild manufacturing, and hold foreign competitors accountable. But critics say the reality is more complicated. Tariffs may punish foreign producers, but they also raise prices for American businesses and consumers. When companies are forced to pay more for parts, electronics, or raw materials, they pass that cost along. Which means if this policy takes hold, American families may soon feel it at the checkout line. Need a new phone? Expect to pay more. A car with foreign-made parts? Higher cost. Groceries imported from abroad? Up goes the price tag. Even American-made goods could become more expensive if they rely on foreign components, and most do. From semiconductors to aluminum, global supply chains are deeply interconnected. Meanwhile, China isn't just retaliating through tariffs. They're reshaping their export routes, turning to other partners in Asia, Africa, and Latin America. China's Belt and Road Initiative has already laid the groundwork for new alliances, and this tariff war may accelerate that shift. Beijing is also betting that U.S. companies, especially agriculture giants, car manufacturers, and tech firms, will pressure Washington to soften its stance. In the European Union, the reaction was more diplomatic, but no less concerned. Italian Prime Minister Giorgia Meloni, speaking at an EU summit, called the U.S. tariffs mistaken, warning that they risk igniting another global economic downturn. The EU has deep trade ties with both the U.S. and China, and now finds itself caught in the middle of two economic titans throwing punches. Behind closed doors, European leaders are debating whether to push back and how. Some are calling for WTO arbitration. Others want a trilateral summit, but so far no unified strategy has emerged. The truth is the EU is in a delicate position. Side too hard with the US and they risk alienating China. Push too hard against Washington and transatlantic tensions could flare. But perhaps the most important question is this: who wins this trade war? On the surface, Trump's tariffs could bring short-term gains to certain American industries, particularly steel, aluminum, and some segments of the manufacturing base. These sectors have long suffered under what they see as unfair competition from countries with lower labor standards and heavy government subsidies. With imports now more expensive, U.S. producers could see a temporary surge in demand. But that's only part of the story. Retaliation from China and other countries could cripple key U.S. exports, particularly soybeans, automobiles, and advanced machinery. American farmers have already raised concerns. They remember the previous trade war from Trump's first term, when Chinese tariffs gutted their access to one of their biggest export markets. Then there's inflation. If import prices rise too fast, the Federal Reserve may be forced to hike interest rates again, slowing down economic growth and making borrowing more expensive for both consumers and businesses. Abroad, China may appear cornered, but don't count them out. Over the last decade, Beijing has quietly built out alternative trade networks. With massive infrastructure investments across Asia, Africa, and Latin America, China is less reliant on U.S. demand than it once was. And by retaliating with precision targeting politically sensitive industries in the U.S., They may apply enough pressure to sway public opinion ahead of the 2026 elections. In Europe, the crisis could push the bloc to rethink its dependency on both American and Chinese trade. Already, French and German leaders are floating ideas of economic sovereignty, pushing for more domestic production of essential goods, from semiconductors to pharmaceuticals. What we're witnessing isn't just a spat over taxes. It's a fundamental reshaping of the global economy, a power struggle between protectionism and globalization, sovereignty and interdependence, nationalism and open markets. So who stands to gain the most in the short term? American steel, aluminum, and manufacturing firms may benefit from less foreign competition. China may strengthen ties with developing nations as it diversifies trade. And the EU could become a crucial mediator, positioning itself as a third pillar in a newly polarized economic world. But in the long term, there may be no clear winner. History shows that trade wars rarely end in total victory. Instead, they leave economies bruised, prices elevated, and relationships fractured. Perhaps the better question is, who can adapt fastest? The nations that weather this storm best will be those who innovate, diversify, and strengthen domestic industries without isolating themselves from the world. President Trump's tariffs have sparked a reckoning, one that will test the resilience of alliances, the flexibility of supply chains, and the patience of global markets. As the world watches, decisions made in Washington, Beijing, and Brussels over the next few months will ripple across economies for years to come. This is the GeoFrontline. Subscribe for weekly breakdowns that cut through the noise, where conflict meets clarity.